Okay, today we're going to cover financial feasibility. You covered on how to incorporate inflation into the capital budget, and then how to incorporate risk into the capital budget. And for this class, we're going to use the risk-adjusted discount rate. Today's lecture, we're going to look at the financial feasibility of individual investments. And part of that, we'll find that we need to know how to amortize a loan. What's happening now is that we basically laid out the principles of the time value of money, saying that if we're going to look at cash flows through time, we have to find a way to transform those cash flows into a common time period that makes a person indifferent. Then we took that information to the next step and talked about how we can actually evaluate a capital purchase to see whether it's profitable or not profitable. Also through that process, we looked at how to look at sensitivity analysis on the data. We've incorporated the inflation now into the problem, incorporated risk. All of that leads us then to make a decision whether or not the investment is profitable or not profitable. The next step is to find out if it's financially feasible. And maybe to help understand why this is important and why you can't just look at profitability, let me ask this question. If you had penciled in coming to A&M that it would have been a good investment to purchase a house and rent out the extra bedrooms as opposed to leasing while you were here, what prevented you from not purchasing that house? The down payment. Or also the fear that you might not get the other bedrooms rented and wouldn't be able to cover the mortgage payment. Both of those may have led you to decide that maybe you couldn't purchase the house. That's what we're talking about in terms of financial feasibility. You can have a good investment, but you may not invest in it simply because you don't have the money initially for the down payment, and you may not be able to cover some shortfalls in the near term of the investment. That's what we're going to talk about today is financial feasibility or liquidity. Liquidity, if you remember from your accounting, is that ability to meet all your cash flows as they become due without disrupting your business. And that's what we're looking at financial feasibility, is to make sure that the investment is liquid. The reading assignment is in chapter 11. And we will soon be through this material and we'll be into chapter 12. And particularly in chapter 12, some of you may have been discouraged in the other chapters because it's not following exactly what we're doing. In chapter 12, the authors begin to merge with the way that we have presented the material in class. You may, if you've slacked off in reading, at least give chapter 12 a try before you completely throw in the towel. Okay, the example that we're working on is the center pivot irrigation system. Hopefully you're not getting too bored with this application. The application really isn't all that important. It's how to crunch the numbers. So we're going to continue with this particular example. If you want to read the verbiage so you can relate the wording to what we're doing, it's page 44 of your handouts. Page 44 gives you the homework type problem so you can compare this. Okay, and when we talk about financial feasibility or liquidity, the question is, does the investment generate enough cash each year to meet all the cash obligations, including the debt payments? Those are the cash obligations associated with that investment, that purchase. Does this center pivot irrigation system generate enough revenues to meet all of the other cash obligations associated with it, including the debt payments? We're basically then going to generate or calculate the net cash flows after the debt payments. And one of the things that we need to recognize that for business, interest is tax deductible. A few years ago they changed the rules so that interest on personal debt is not tax deductible. Your credit card debt, okay, for personal purchases is not tax deductible. But if you have a credit card for a business, or if you have debt from a business, then it is tax deductible. Okay, we're going to go to another chart. You may be tired of charts, but charts help us to systematically and sequentially work through these problems. So no surprises across the top. We have a timeline, okay, per period of timeline. And then vertically, we're going to continue disaggregating this into its components. The first component is the net cash flow before debt. That's the exact bottom line that we used in the chart used to calculate the net present value. Even though we haven't been using that, it's been part of our chart where we sum up each of the columns when we're calculating the net present value. That becomes the first line on this particular chart. The next line is the initial loan amount. Okay, this is the amount of money that we borrow initially for the purchase of this investment. The third line, this LPMT, is the loan payment per period. And that loan payment includes interest and principal. The fourth component is the marginal tax rate times the interest, because interest is tax deductible. So this item is the tax savings from paying interest. As we said, interest can be deducted from the taxable income, and if you reduce your taxable income, that reduces the amount of money that you owe the IRS, and we claim that as a positive return. Okay, the fifth component is LN, where N represents the maturity of the investment, and that represents the balloon payment of the loan principal in the nth period, and it's after paying the scheduled loan payment in that last period. So it's what remains on that note. Okay, that may be zero. You know, if you take out a 30-year note and sell the investment in 5 years, you still have a balloon payment that has to be paid. And then, of course, the last line is the net cash flow after debt, which is what we're trying to get to, is to see if there's, after accounting for the revenues associated with the investment and after paying any debt obligations, what's left. Is that positive or negative? Okay, if you go back in your notes, looking at how to incorporate the inflation and risk in calculating the net present value, you will see this chart. And you'll recall that the net present value was $2,331 for this irrigation system. It was a profitable investment. From a standpoint of being profitable, we'll say yes. But what about its liquidity? What about its financial feasibility? And that's where we bring in the second chart that we just covered in the previous slide. It's a table used to calculate the cash flows after debt. And notice that, as you can see, the net cash flow ends on the chart for net present value, begins the chart used to calculate the net cash flow after debt. Again, the sequential process. You got to solve one, and it feeds into the next part. Okay, I've blown up this chart. Notice that the net cash flow, those numbers, where did they come from? Those come from the chart that you used to calculate the net present value. No magic here. They just follow from the previous chart. Okay, the second line, this L naught, if you look on page 44, information has been given that a lender will loan the farmer $75,000 to buy this irrigation system. And since it cost $80,000 and borrowed $75,000, of course, the farmer's going to have to come up with a $5,000 down payment. Well, if he borrows $75,000, what is his annual loan payment if he purchases this irrigation system? Also on page 44, it says this loan will be fully amortized at 10% over 6 years. This is a fully amortized loan, and it implies that you have an equal periodic payment that includes both the principal and interest. Okay, so the principal and interest are going to change such that it's always a constant payment. And what formula do we use to calculate a debt payment? Since we said we want a uniform payment, we're going to use present value of a uniform series formula. Okay, and we've done this before. You've done this as part of your homeworks. We've done it in class, so it isn't anything new. But we're going to start out in our timeline. In this particular case, we said the loan was going to be fully amortized over 6 years. We're borrowing $75,000. The rate is 10%, and we're trying to find then what is the payment so that the lender receives 10% return on the $75,000 that they are going to lend this farmer. Again, we use the present value of a uniform annuity formula. Of course, the present value is $75,000. The rate's 10%. The period is 6. We're calculating the A. So we can plug this directly into our calculator where we have 6N, 10% I, $75,000 present value. We zero out the future value and we compute the payment, and it comes out to be $17,220. Okay, so on our chart, we put the $17,221 at the end of each of the first 3 years. And the reason that we only go to 3 periods instead of the 6 is because in the verbiage on page 44 it says this farmer plans to replace this irrigation system at the end of 3 years. So we don't need to continue that any further than just the planning horizon of the 3 years. And again, as you recall, I only choose 3 years because it fits neatly on the screen. Obviously, if I was doing this, the planning horizon of an irrigation system would probably be quite a bit longer than 3 years.